Friends, today's topic is recent judgments in income tax. We all know that now the era of litigation has come, even at the assessing officer level. We have to prepare our drafting, our replies in a very detailed way, because if you do mistake in submission of your replies at assessing officer level, if the case travels to higher authorities up to Supreme Court, we will not be in benefit, because that will be considered. So we need to understand all the litigations and all the judgments that has been decided by the honorable courts. And we have none other than Advocate Mohit Balani, a young taxation advocate who is practicing in various courts, and he will enlighten us that what are the views and what are the decided paths in the courts, and according to that we can advise our clients for their future litigations. I request President of Income Tax Bar, newly appointed President of Income Tax Bar Association, Shri Dhruvin Mehta. I think we are doing this first webinar together to give his brief speech.
Thank you, Karthikeya bhai. So this is our first webinar as said by the Karthikeya bhai. So thanks to all AGFTC and all other associations to allow us to participating in this webinar. And I am very much thankful for this. Today is our speaker and my friend, CA Advocate Mohit Balani. He will discuss on the matters which are going through the courts and discussion on this. The most important thing is that in our language, in law language, there are few words or there are few lines which have a dual meaning in different matters. So these things are going through the courts for their exact meaning. What is the exact meaning for what particular thing? So for this, we have to understand the language of the law and how court interpreted this, and the discussions, how court interpret that discussion. So that will more benefited to us in our practice. So thank you, Mohit bhai, and stage is yours, sir.
Just a second. I request Vice President of Income Tax Bar Association, C. Ashish Tekoni, to give the brief profile of today's honorable speaker.
Hello, everyone. It is my pleasure to introduce our eminent speaker in the first webinar of the year 22-23. Mohit Balani is a chartered accountant turned lawyer, having knowledge of direct tax, indirect tax, company law, and economic offenses. He has passed his LLB in the year 2020 and had passed his CA in the year 2013. He was litigation associate from August 2014 to December 2021, associated with senior advocate Tushar Hemani. He has argued matters relating to direct taxes, indirect taxes, Benami properties, and other commercial and fiscal laws before Honorable High Court of Gujarat, ITAT Tribunal, CESTAT Tribunal, Appellate Tribunal for Fortified Properties, and before Commissioner of Income Tax Appeals. He has also actively advised large corporates like Kandla Port Trust, Disman Cargo Gen, Dishman Infrastructure, Kiri Industries, Atul Limited, and others. He has also handled the search cases under the IT Act of various large groups in Ahmedabad. He is actively involved in writing blogs which can be read at mohitbalani.com. Sir, we welcome you and the floor is yours.
Just want to say only one thing about sir. Even if his father is admitted to the hospital due to some emergency, he has not cancelled this webinar. He has come specially to brief all of us. So we really respect your enthusiasm and your selfless service to all the members. Thank you, sir. Thank you so much. Stage is yours.
Thank you so very much for such a fine welcome speech. I am highly grateful to all the panelists, members, as well as all the participants today. Our discussion today is limited to recent judgments in income tax portfolio. With that, I would like to start and would first like to share my screen. Dhruv bhai, હું share કરું છું. Is this visible to everyone?
Yes.
Yes.
Yes. So the first judgment in hand is with regards to section 55A. Before I start, can I use English and Gujarati both, or Gujarati would be convenient to everyone?
Both.
Okay. With this, the first judgment in hand is section 55A. The judgment's name is Gautam Babar Bhai Patel. What was the issue involved in this case? The issue pertains to assessment year 12-13. What had happened was, we know capital gain ma usually calculate करते वक्ते we need cost of acquisition of some past date for claiming the indexation cost of acquisitions. 1481 હોય હવે 2001 થઈ ગયું છે. So what had happened in this case was, the assessing officer wanted to challenge the valuation date of 1981. 55A provides them that power to refer a matter of valuation to a valuation officer. But the conditions are specific. The conditions stated therein are in a case where the value of the asset as claimed by the SSE is in accordance with the estimate made by a registered valuer. If the assessing officer is of the opinion.
Mohit, sir,
Sorry.
I would like to interrupt. The screen is not rolling. I think your old shared screen has frozen. So please remove screen share and retry it.
Okay. Is it visible now?
Yes, now
Yes,
perfect.
now it is visible.
Okay. I'll restart my briefing now. The first judgment is with respect to section 55A, reference to DVO, the powers of DVO in this case. We all know that in case of claiming cost of acquisition, at times the properties are purchased or received by an SSE before 1981 or 2001 as the case may be. So we usually place the copy of registered valuer's report. In this case, a similar fact have come arise. However, what has happened is the assessing officer challenged that valuation. He was of the opinion that you have claimed cost of acquisition more than fair market value as on that date. The case pertains to assessment year 12-13. Now the question arises whether such an action can be done by a DVO in this case or not. So this section reads as this wise. In a case where the value of asset as claimed by the SSE is in accordance with the estimate made by a registered valuer, if the assessing officer is of the opinion that the value so claimed is at variance with its fair market value. This is the new provision with respect to assessment year 13-14. The old provisions were like this wise. So the section read as under. In a case where the value of an asset as claimed by the SSE is in accordance with the estimate made by the registered valuer, if the assessing officer is of the opinion that the value so claimed is less than its fair market value. So a reference could be made only if assessing officer is of the opinion that the value so claimed is less than the fair market value. However, in this case, the assessing officer referred the matter to DVO on the premises that the value was more than the fair market value. The court held that such an action is bad. No reference could be made to DVO, and the valuation so adapted on the basis of fair market value calculated by DVO has no value because the powers have been exercised ultra vires to the act. This is the first section, first judgment. I have reproduced relevant observations. The PPT shall be shared after the lecture so that this can be used straight away if such circumstances do come. The next judgment, Vinod Kumar S. Totla, relates to section 154 of the Act. It explains to us what is the mistake apparent from the record. 154 section, as we all know, gives power to an assessing officer to correct a mistake apparent from the record within a certain time limit. That is the rectification provisions of section 154. But what is mistake apparent from the record? Supreme Court as well as various high courts have held that a mistake apparent from the record is such a mistake which does not require deliberate or arguable or debatable things. Question of facts which can be cured in seconds, 5 minutes argument is a mistake apparent from the record. Long drawn processes, long drawn arguments, long drawn legal debates are not covered in mistake apparent from the record. In this case, the SSE purchased a property in 2009. However, he was holding the property since 1987. He claimed cost of acquisition from 87, indexation from 87, on the premises that he was holding the property from 87. However, the registered deed which gave him the right to that title was in 2009. Assessing officer invoked the powers of section 154 on the premises that you have claimed indexation from 87, whereas your deed suggests it is 2009. The SSE argued the facts that this was purchased, Banakat was done in 87, XYZ, I was holding this property. He placed n number of things to claim that it was from 87 only. The tribunal ultimately held that these are factual inferences, these are factual things which requires a long drawn argument. It is not a straitjacket formula. Hence, section 154, which is confined to mistakes apparent from the record, shall not be applicable in the case. Assessment order could have been done in 263 revision. Reopening is possible. Everything is possible, but not section 154. So mistake apparent from the record is something which is not out of long drawn process, long drawn arguments. It has to be a simple mistake, arithmetic or anything, but no long drawn processes should be there in this case. However, at times we have queries with regards to as to if a jurisdictional high court judgment is in favor or against the assessee, whether that shall be covered in section 154. The answer to that question is yes. In the context of section 143(1), Supreme Court in the case of Raghuveer Steels held that if a jurisdictional high court judgment is there then it is binding on the assessing officer, and if he fails to do that, then it is a mistake apparent from the record. Raghuveer still Supreme Court. That is the law. That will also help us out in section 153(1), wherein similar wordings are used. Mistake apparent from the record. For that aspect, 143(1) do provides assessing officer or CPC to adjust the income of the assessor. The third line of judgment is with respect to power of revisions of order prejudicial to the revenue. Section 263. Section 263 gives power to an assessing officer or principal commissioner or a commissioner to correct an order on the premises that the assessment framed by the assessing officer is erroneous and it is prejudicial to the interests of the revenue. So any error which is not prejudicial to the interests of revenue is not covered under section 263. Any action which is prejudicial to the interest of revenue but not erroneous is not covered under section 263. There are twin conditions. First, erroneous. Second, prejudicial to the interest of the revenue. However, 263 gives limitation aspect with regards to as to when action can be initiated, or an order under section 263 can be passed by the commissioner. The powers are 2 years from the end of the from the date of the passing of the order. 2 years is the time given to a commissioner to correct that error, if any, committed by the assessing officer. In this case, Madhya Gujarat Witch Company Limited, there were 2 assessments being done. First, the normal scrutiny assessment. Thereafter, reopening. 147 નું order pass થયું હતું ને પહેલા 143(3) નો થયો. So there were 2 assessments being framed. Reopening was conducted on the premises that you have not provided prior period income, you have not offered that, and you have also claimed prior period expenses. That was the premises on which the reassessment was done, assessment frame, additions, disallowances done. Now 263 is being invoked by the assessing officer on something independent of what was being picked up in reassessments. Assessment, reassessment prior period. Third point was, the 263 invoke karyo, that was an independent issue from the reassessment. From within 2 years from the passing of the order under section 147, reassessment order passed થયો ને 2 વર્ષમાં એમને 263 invoke કરી દીધા. So prima facie it looked that it is within the powers. However, Supreme Court has laid down a law in case of reassessments, and thereafter if you want to correct it under section 263, the reassessment order, the issue must pertain to the reassessment only. So he could have, the principal commissioner could have invoked 263 if the issue or the error that he was pointing it out was related to the reassessments. Otherwise, if he wants to correct the original assessment, then limitation would be calculated from the date on which original assessment order was passed. Madhya Gujarat Witch Company Limited. I hope I'm clear on this. If anyone has query, they may certainly raise their hands. I'll be addressing them.
You can take query at that.
Okay. The next issue is with respect to claiming of a long-term capital loss against an exempt long-term capital gain. This is prejudicial to the interest of the SSE. No one would do that. We all know that. Long-term capital gain which is exempt does not form part of the total income. For example, if I sell a share, I'm talking about the past loss. I hold shares for 1 year. I sell it within 1 year. Short-term capital gain, no exemption under section 1038. However, if I hold for more than 12 months, I claim long-term capital gain under section 1038. I don't, while computing the income, I don't include such income in my computation of income. I straight away reduce, this is the income, this is the reduction, it is exempt under section 1038. In the case of Sikha Sanjaya Sharma, ITAT Ahmedabad, assessing officer found that the assessee has claimed long-term capital gain and it has simultaneously carry forwarded the long-term capital loss. So he adjusted long-term capital loss against LTCG first, reduced the amount of LTCG, and the amount of exemption was reduced. However, the SEC gets aggrieved by the fact that the long-term capital loss, which was otherwise could have been carried forwarded to the next years, was disallowed. There are simultaneously two tribunals which provide that this action is otherwise legal. Bombay Tribunal as well as Kolkata Tribunal. They both provide that this action is reasonable and legally allowable. However, Gujarat High Court does not. So, question arose whether Gujarat High Court would prevail over Bombay and Calcutta. The ITAT Ahmedabad followed the jurisdictional High Court. This is simple. They ultimately even disagreed with the fact that this action is otherwise absurd. This is not possible because long-term capital gain, which is otherwise exempt, does not form part of the computation of income. Any set-off or anything must necessarily include such income in the computation of income. Because LTCG under section 1038 is never part of the computation of income, there cannot be 70, 71 or 72 in those cases. So 70, 71 and 72 are after you have everything. The income is determined as per section 40, the heads of income. Once you have those heads, thereafter you can have interhead, you can have intrahead. But if some income is not forming part of the total income, that cannot be used for the purpose of section 70, 71 and 72. So whether long-term capital losses can be adjusted against exempt long-term capital gain, the answer is no. Gujarat High Court as well as this tribunal. The next judgment in line, P. Gautam and Company, it relates to section 40 capital A clause 3. 40 capital A clause 3 provides that if I incur some expenses, payment have been made in cash beyond a certain limit, beyond the prescribed limit, then such expenses are disallowable under section 48. There is a special clause for it in tax audit report as well, wherein tax auditors are required to report whether SSC has incurred any expenses under section 4, which is in violation of section 48(3). The limit was 20,000. Now it has been reduced to 10,000 rupees. Exception to this rule is provided in Rule 6DD of Income Tax Rules 1962. There are various exceptions. For example, agriculturist na case ma cash is possible, cash payments are possible. Second is कि जहाँ अगर banking facility available ना हो, यहाँ 6DD ना हिसाबे 48(3) disallowance is not required to be made. Third is book adjustment. Book adjustment के करियो है इमा 48(3) applicable ना था. There are exceptions provided in, but the question arises whether such exceptions are exhaustive in nature or not. Exhaustive meaning that there are 6 to 7 examples provided in 6DD. એટલા પૂરતું જ રહેશે. કોઈ 5થી 7મી કે 8મી જે આમાં પ્રેસ્ક્રાઇબ નથી કરેલી સિચ્યુએશન, whether that can be included. The Ahmedabad tribunal has recently held that yes, these are not exhaustive in nature. If there is some circumstances not provided in 6DD, that shall still be considered as an exception. But there are two conditions that the tribunal has prescribed. First, such expenses are genuine. SSC has provided everything with regards to its genuineness. And second is, first is with regards to that expenses have been incurred, and second is it should be genuine. All the proofs with regards to its genuineness are provided by the SSC. Evidences such as confirmations prove that the other party confirms that I have expended. And the SSC has to provide the reasons as to why he has made such payments in cash. It can be any reason. In this case, the SSC explained that I had to make such payments after the banking hours. It was 7 p.m. and the supplier was forcing me to pay, otherwise I would have lost the contract. Tata in this case was the supplier. So SSC explained both the things. Confirmation was provided, vouchers were being bills, invoices, everything was placed, and it was explained that this cash expenditure was done after the banking hours under exceptional circumstances. The tribunal held that because genuineness of the transactions have not been challenged by the assessing officer, 48(3) disallowance in such cases should not be made by the assessing officer. So the disallowance was reversed by the tribunal. The next judgment in line, 263, revisional powers that we discussed earlier. However, now the question is with respect to lack of inquiries versus inadequate inquiries. We time and again received notices under section 263 that assessing officer has not carried out adequate inquiries, not carried out falana digna, everything. Inquiries have not been carried out. But the law is well settled on this aspect with that what is lack of inquiry and what is inadequate inquiry. For example, a show cause notice has been issued to me, calling for certain expenses. These expenses are disallowed because you have not provided the vouchers or anything. Now I provide everything. Assessing officer says, because you have provided supporting documents, now I don't want to disallow. The assessment order is passed without making any disallowances. So inquiry has been done. But Commissioner is of the opinion that this inquiry is inadequate. Whether powers under section 263 can be invoked in such cases, as per this judgment, the answer is no. This judgment explains as to what is lack of inquiry and what is inadequate inquiry. Lack of inquiry is something that he does not even look into those claims claimed by the assessee. For example, I claim exemption under section 54. However, that is not being verified by the assessing officer. That is a case of lack of inquiry. However, if he checks everything, but he does not gets into the depth of the issue, that is inadequate inquiry. 263 can only be done if there is lack of inquiry. There has been an amendment thereafter. The amendment reads as like this. Explanation 2. For the purpose of this section, it is hereby declared that an order passed by the assessing officer shall be deemed to be erroneous insofar as it is prejudicial to the interests of the revenue if, in the opinion of principal chief commissioner or principal commissioner or commissioner, the order is passed without making any inquiries or verification which should have been made. The key word herein is without. If there is no inquiry, it shall be deemed. It was otherwise the case was like this only. 263 could only be invoked if there was lack of inquiry. The amendment does not affect the law laid down by the High Courts and the Supreme Courts before. The law is still the same. It may arise that because it is being amended and there is a deeming fiction added to it, the cases of inadequate inquiries have now been incorporated. But the answer is no. I'll reread it. 263 can be invoked only and only if the order is passed without making any inquiry or verification. So all those cases of inadequate inquiries are not covered under section 263 of the Act. The next judgment relates to CSR expenses. We all know that under section 135 of the Companies Act, a company is required to expend 2% of the profit towards its corporate social responsibility. With the amendment of section 37, explanation 2 has been added, which says that any expenditure incurred by an SSE on the activities relating to corporate social responsibility referred to in section 135 of the Companies Act shall not be deemed to be an expenditure incurred by the SSE for the purpose of business or profession. So explanation 2 creates a fiction. The first fiction is such expenses first were always business expenses. Second, but because it has been done compulsorily under section 135, we want to make it disallowable. two things. First, it was always an expense, but with the incorporation of explanation 2, now they are disallowed. However, let's just say we donate certain amount to otherwise a trust who is otherwise covered under section 80G of the Act. There have been a lot of debate on this question, that whether CSR expenses, CSR donations are still disallowable. Assessing officers have been doing that. They are invoking explanation 2 to section 37 into 80G as well. An assessee who otherwise disallows every amount claimed under section 37 relying upon explanation 2 and claims such donations under section 80G are going through a litigation. That whether such expenses, whether explanation 2 shall be applicable to 80G as well or not. With the development of law, Bangalore Tribunal has now come up with Bangalore Tribunal as well as Kolkata Tribunal. Bangalore Tribunal in the case of Goldman Sachs and JMS Mining insofar as ITAT Calcutta is concerned. They have ruled out invocation of explanation 2 in relation to section 80G now. So, if an assessee claims such expense under section 80G, such donations under section 80G, that shall be allowable. So CSR expenses which were otherwise disallowable under section 37, CSR donations allowable under section 37, disallowed by way of explanation 2, shall be allowable under section 80G of the Act, as per the conditions stated therein. However, explanation 2 cannot be incorporated in section 80G. The next judgment in line, Supreme Court in the case of Ashish Agrawal versus Union of India, the very famous old versus new litigation. Fresh notices have started getting issued by the assessing officers now. Same old issues that were being dragged to High Court and ultimately to Supreme Court are again have become live. Almost 90,000 notices have become live just because of this judgment, which has been done by invoking Article 142 of the Constitution of India. We all know that all those notices which were being issued from 1/4/2021 to 30th of June 2021 have been again asked to comply with the new provisions under section 147, 48, 49 and 51. The 4 directions provided by the Supreme Court, I have reproduced it. The Supreme Court has treated all the old notices as notices under the new law. It has been specifically said that all those notices shall be notices issued under section 148 capital A clause B, the show cause notice. It has also been asked to the assessing officer to provide all the materials that were relied by the assessing officer before while issuing the old 148 notice along with this new notice. Thereafter, the assessees have been asked to respond within 14 days from the receipt of such notices. the assessing officer has to necessarily consider all the objections and thereafter pass an order under section 148A clause D. I have been briefed in a lot of matters now. I have been receiving a lot of queries. These are the key line of defenses that are available with the SSEs while challenging those notices. List of defenses include time barring in case of assessment year 13-14 and 14-15, irrespective of the amount. All the notices that involves an amount of less than 50 lakhs have now been ruled out. In fact, there is an instructions from the CBDT itself, instruction number 1 of 2022, suggesting that wise. So all those notices which involves less than 50 lakhs have been ruled out by the board as well. However, 13-14 and 14-15 would be still barred by limitation, considering the first proviso to section 149. I have been receiving notices which are absolutely non-speaking. They only reproduce the observation of Supreme Court. Such notices would not prevail before any High Court. Such notices are non-speaking. If there is no allegation as to how income has escaped assessment, that cannot be termed as a show cause notice. They have to necessarily incorporate what is going on in their head. The other line of defenses can be formation of belief is a borrowed satisfaction. It has no nexus with the material. Time provided by the notices is not as per the direction of Supreme Court judgment, which is 14 days, 2 weeks time. If they provide it a lesser time, it is against the directions given by the Supreme Court. Change of opinion. If some issue has already been taken care of by the assessing officer while passing the assessment order, original assessment order, the same cannot be relooked. Calvinator of India Supreme Court. They don't have power to review. Power of review is a special power conferred only by way of statute. If statute does not provide it, they don't have any power to review. Not in possession of books or documents or evidences. If he is not in possession of books, evidences, and he is presuming the escapement of income, such notices shall be bad. The escapement of income is not represented in the form of assets, that shall also be covered. This is very interesting. No previous approval. Each and every notice is issued after 3 years from the date of relevant assessment year, have been issued mechanically without any previous approval. In line with this Supreme Court judgment, they are interpreting the judgment in a very wrong fashion. My view is they are required to seek those approvals as per section 151 para 8 provides that they have to comply with each and every provisions of 148 capital A clause B as it existed at the time of issuance of original notice. But all the notices have been issued mechanically without any approvals. They are relying upon their old approvals. That is incorrect. They have to necessarily seek a fresh approval in accordance with the fresh 151 section. If at all materials are not provided, that can also be a ground for challenge. (148) capital A clause B in the statute book provides that a show cause notice must provide 7 days time. The statute itself provides that the notice must provide 7 days time or anything beyond that. Thereafter, extension can be sought by an SAC. However, what happens if the show cause notice provides 3 days time or 4 days time? Delhi High Court, in the case of Sri Sai Cooperative Thrift and Credit Society Limited, held that such notices would be bad. If a statute provides a certain action to be carried out in a particular manner, it has to be done in that manner only, strictly. We have our own Gujarat High Court judgment in the case of Nana Lal Tribhuvan Das 100 ITR 734. Suggesting this similar principles. Though in the case of 1934 Act, Section 22 governed the provisions of section reopening in 1934. Section 22. Thereafter, new act came, 1961 Act. It provides 147 provides the reopening powers, and now 148A, 147 fresh reopening law has been brought in by the legislature. However, the principle still holds that if the statute provides that certain amount of time has to be provided to the assessee, the notice must provide at least that much time. If 7 days time has not been provided, it violates provisions of section 148 capital A, and such notice would be void ab initio, in my opinion. The next question would arise, sir, if I respond to it without objecting to such invalidity, what happens? My humble opinion is the notice would be still void. Your actions, SEC's action, cannot correct the mistake of an assessing officer. It would still be a defective notice. It would be an illegal notice. So it can be challenged before the appropriate authority at the appropriate time. (148A) capital C, non-consideration of reply by an assessing officer. After the issuance of notice under section 148 capital A clause B, the assessee responds to the objections or the allegations made in the show cause notices. However, cases have arrived wherein the orders have been passed under section D, 148 AD mechanically without even considering the reply. There has been non-application of mind by the assessing officer. What happens then? Whether 148 capital AD would be correct in law? Delhi High Court, in the case of Divya Capital 1 Private Limited, held that 148D would be bad in law. A similar rule of judgment has been passed by Gujarat High Court now. It has still not been reported, so I have not placed the copy of, I have not placed the citation. It is still an unreported judgment. However, Gujarat is now there in line. Consideration of replies has to be there in case of 148A as well. If no such consideration is discernible, order જોઈને ખબર નથી પડતી કે એમને consider કર્યો છે કે નથી કર્યો, what happens? That order is bad. The entire reopening proceedings thereafter is bad. The next line of judgment is with regards to prosecution. Prosecution under section 276(c). However, principles have been laid down by Supreme Court in the past in the case of Suraj Lamp. The principles are like this. If a penalty has been deleted by an appellate body, prosecution in such cases should not be launched. However, what happens if penalty has been deleted on technical grounds, such as limitations, non-application of mind? What happens then? Whether prosecution can be launched? The principles are also settled that civil remedies as well as criminal prosecutions can go hand in hand differently. One body does not have to wait for the other body. S.J. Surya, Madras High Court suggests that if penalty has been deleted on the premises of a technical ground, then prosecution is still maintainable. So until and unless there is no concrete finding as to non-involvement of an assessee, there is no mental state involved in it, there is no escapement of income, then and then only prosecutions can be quashed by the high courts. If penalties are deleted on technical grounds, prosecutions are maintainable and the assessees have to go through the trial mechanism. Chief Metropolitan Magistrate, thereafter Sessions, thereafter High Court, they have to go through the entire channel before they are being acquitted. One of the most deadliest sections in Income Tax Act, presumption of mental state, 278 capital E. We all know any criminal liability arises only if there is presence of mens rea. There are certain sections in Income Tax Act which allows prosecution without that. However, most of the sections provide a concept of mens rea. Mens rea basically means done with an intention. If you evade taxes with an intention, that is mens rea, covered under section 276 capital C. 278 capital E provides that wherever the act requires mens rea, it shall be presumed. Lots of prosecutions have been lodged throughout these years after insertion of 278E. They don't check anything. They simply presume that there is mental state, and the prosecutions have been launched in n number of cases now. Madras High Court, in the case of Noor Jahan, is a welcome decision. It says that if the offense or the charge, which is the basis of complaint, has been cured before the launch of prosecution, 278 capital E presumption would not arise. I repeat, presumption would arrive only if at the time of launching the prosecution, the offense is present. For example, I file a return of income. I don't pay the requisite taxes under section 140 capital A, self-assessment tax. I may go through some kind of trouble. Let's just say I'm going through bad financial condition. I'm not able to pay those taxes. I do file return of income. but I correct my mistake before the prosecution is launched, or the notice is issued under section 276 capital C, whether 278 capital E can be invoked in such cases? As per Madras High Court, the answer is no. I have corrected my mistake. There cannot be any mens rea for committing the offense. Before you catch me, I have already corrected my recourse. So this is it, friends, from my side. I hope I was clear. I'm ready for all the questions.
Sridhar bhai.
Yes. So we have two questions in chat box. There is one question. Whether all notices for assessment year 13-14 and 14-15 time bar, if notice issued, then what to do?
(13, 14 and 14, 15), it is debatable. However, the point is arguable, because the CBDT came out with two notifications. Notification number that was being issued at the fag end of the March, and thereafter in the April. Now, when the new law was brought in, it was brought in with effect from 1st of April. And the CBDT was clear. They wanted to extend the old law. And every High Court has said that old law is now been substituted by the Parliament. You could not have stretched the applicability of laws. That is beyond your powers. Supreme Court has said every High Court is correct. So all those notifications related to the old law. So the point is arguable. It would be a question of debate. And what should be done in those cases? You can always object to it, that these are time barring. Even if you don't do, that would not matter, considering this is pure question of law. However, I suggest to incorporate such objections in your reply itself.
There is another question from Mukesh Doshi. Can penalty be levied by JCIT when it has not been initiated in assessment order by assessing officer?
The answer is no. I'll tell you why. If I am not wrong, this is pertaining to the old penalty section 271(1)(c). I need a factual correction with regards to that.
Mukesh, I'm allowing you to talk. Okay, so you can clarify the question. Yes, Mukesh.
Hello.
Yes, Mukesh, we can hear you.
Yes, sir. It is in relation to section 269 ST regarding the 271 capital E penalty in new regime.
Sir, penalty under
270 capital E. 270 capital E, if I'm not wrong.
Reference to section 269 ST.
But that can be done in 271E.
271E.
Not wrong. Yes, it can.
But
it cannot be done
but
in
with reference to 270 269 ST, accepting
yes.
of cash payment in excess of rupees 2 lakhs.
Yes, but that is not covered in 270 capital E.
Capital E, sorry, sir.
Sir, under which section you have been levied penalty?
Just 1 minute, sir. 1 minute, only 1 minute, sir.
It must be in 271E.
271 DA. Sorry, sir. 271 DA, capital DA.
Yes, the answer is yes. A joint commissioner can.
Even though it has not been initiated in assessment order.
That is fine.
Okay. Thank you, sir. Thank you.
Anyone having question can put it in chat box as well as can raise hand. So it seems like we are not having any questions, further questions. So over to Karthikeya bhai.
Rovin bhai, you can proceed.
Okay. Thank you, Mohit bhai. First of all, it was a nice experience with you. And I want to thank you, our President Emeritus, Sri Dinesh Kaka, for joining in our first webinar. Thank you, sir, for your time. Now I request Honorable Secretary Sridhar Shah for vote of thanks and for certificate.
I request Shivam bhai to present the certificate to sir. I think you might be having some technical issue.
Mohit bhai, I want to tell one thing. AGFTC's initiative is to give opportunity to young tax professionals who are belonging to our profession to sign out through webinar. So you are giving your speech on the first time on the AGFTC and ITPA platform. Thank you so much for today's webinar. But I must say that your slow but definite speech is really amazing, and it gives all the understanding instantly. So carry on with that.
Thank you, sir.
And sir, please accept this certificate of appreciation. It matters a lot when new speaker come to us and share their knowledge. And we are lucky to have a good pool of speakers who can deliver lectures on different topics with such clarity.
With your permission, we will share your PowerPoint presentation.
एक मिनट धीरेश काका ने बोलू છે एक મિનિટ यस जय सर बोलो
મોહિતભાઈને આપણે પહેલી વાર સાંભળ્યા મેં તો વેરી લિસનલ લેંગ્વેજ એટલે દર 2 મહિને નવા નવા જે જજમેન્ટ આવ્યા હોય એનું શનિવારે 1.5 કલાક માટેનું જો આપણે રાખીએ તો લેટેસ્ટ જજમેન્ટથી આપણે માહિતગાર થઈ જઈએ અને આપણે બધા વાંચવા માટે તો ટાઈમ કાઢતા નથી અથવા વાંચતા જ નથી. આજે એમને બધા જજમેન્ટનું જે સરસ શાંતિપૂર્વક ડિસ્કશન કર્યું એ શિરાની માફક આપણને ઉતરી ગયું ઘરે કે આમાં આમ થાય ને આમાં ના થાય. એટલે મોહિતભાઈનો મને પરિચય બી નથી આવતું પણ ઇઝ અ વેરી ગુડ સ્પીકર. આપણા માટે તો બહુ જ સારા છે. તો ફરીથી મહિને 2 મહિને જ્યારે તમને એ લાગે પણ સેટરડે રાખવું, રજા હોય એટલે બધાને ઉતાવળ બી ના હોય. 4 થી 5 અથવા 4 થી 5:30 અને 1.5 કલાકથી વધારે તમે રાખો ને પછી લોકો મગજ બી ભારે થઈ જાય છે. 1.5 કલાકનું જ રાખવાનું બહુ થઈ ગયું. થેન્ક યુ.
Thank you, Dinesh. Dhruvin bhai.
Sridhar bhai.
Okay. So it is indeed a pleasure to propose vote of thanks for the first webinar for IT bar in the activity year 22-23. We had an excellent lecture of Advocate Mohit Balani on recent judgments in income tax, and he literally took out the portions which are very relevant in the judgments, recent judgments, and which are mostly applicable to so many people. So the judgments having impact in cases of many assesses. So it has been really been helpful to us, and thank you, Mohit bhai, and for solving the queries also. Thank you. And also I want to announce to all the members who have joined the webinar that tomorrow we are having another webinar. We have already shared the flyer with you. On 7th, we have a webinar on RERA, and tomorrow we are having webinar on CIT appeals. So please join us and take benefit of the day. Thank you. And with this, we end this webinar. Thank you.